A wonderful morning to all of you. This is Magdalene from Itus Capital, and I'm glad to welcome you all to our 2Q Investor Call 2025. Thank you all for taking the time to be a part of our Saturday call. At this time, all the participants will be on listen-only mode, and after a brief presentation by our founder and fund manager, Naveen Chandramohan, we will have the Q&A session. During this call, Naveen would walk us through on our portfolio's performance in the last quarter gone by and discuss his views on the market. Let's hear from him. Over to you, Naveen.
Thank you, Magdalene. Thank you to everyone who's attending this call today. We'll start off. I'll just give you an overview of what I would want to do through this call. We'll start off by reviewing the performance. We'll look at where the macro is today. From a very top-down perspective, we'll look at covering how do we think about sectoral exposure, how do we think about flows, and how do we think about policy, and translate that into concentration in the portfolio that we build in terms of our position sizing. That will automatically lead into how we are positioned across sectors. We'll look at the portfolio as well as the expectations for the year over the next 2 quarters. In terms of our performance since inception, the fund has, once you are invested in the fund since inception, would roughly be worth around 4.3 CR today. The same invested in the index would be at 3.46. How does it translate it in terms of an IRR? The fund has generated a post fees and expenses of 18.72% since inception. If you look at our 2025 returns, you will see a brief underperformance in calendar year returns. I'll look at breaking it down slightly further around where it came from and how the trend of the performance has been in the last quarter and how I would expect this to be in the next 2 quarters. So if I look at our performance in 2025, Jan and Feb was a period of underperformance. As you can see, the fund underperformed Nifty by close to 7.2%, whereas there was a consistent outperformance over the next 4 months. Where this performance came from over the first 2 months, typically in periods of drawdowns, I would expect our positioning to ensure we fall lesser. However, this was an anomaly in terms of the first 2 months, predominantly driven by our pharma exposure, which had a significant drawdown in Jan and Feb, considering there was noise on the tariffs. I had spoken about this in the March quarter, saying that this has to revert, primarily because earnings was not deteriorating. And even if the worst case tariff news had actually come into fruition, this would have resulted in margin expansion for many of the Indian pharma companies. So far, there has been a reversion in terms of both earnings and margins, and there has been that reversion in terms of the performance. In the future slides, I'll break it down at both sector as well as company specific level. But the broad gist of this is, while the quarter gone by has seen this outperformance come through, I expect the subsequent 2 quarters to continue along the same way in terms of this outperformance. Now, purely in terms of macro, in the previous call, I had spoken about the fact that there are 2 aspects in terms of dealing with Indian macro. The first aspect is looking at the government's balance sheet, which today is in the best health that you have ever seen over the last 15 years. What do I mean by that? Our tax collections is staggering today at a year-on-year growth of around 9%, as a result of which you had a healthy spend of CAGR of CAPEX between 21 and 24. 25 was a mean reversion year, predominantly because some part of the spends went into rural as elections took place. And 26 today, because of the fact that we've had to cut our fisc, we've expected that the CAPEX spends at the government side should be lower than expected, which is what we had actually spoken about in the previous quarterly call. Now, the numbers are out for the first 2 months of the year. The broad takeaway from this is just 2 aspects that are highlighted. As you can see, the total receipts is actually grown on a year-on-year basis by roughly around 21%, which means, the actual growth from a year-on-year perspective is 18.6%, but against the estimates you are actually at 21% of your estimates for the first 2 months, which means you are ahead of the estimates. Similarly, your capital expenditure is at 19.7%, out of which the loans disbursed has been fairly healthy, which means both on the collections as well as on the spend side, you are running ahead of ahead of what you have budgeted for. However, there are two variables that remains to be seen. Can this revenue run rate continue? To us, it looks a bit hard over the next few quarters because there has been some amount of upfronting in the year that has been done in order to get a slightly higher estimate. And does the capex spend continue? I think the capex spend does continue, but you don't have the leeway for you to continue this spends, considering that in Jan 26, there is a pay commission coming due, where that will result in higher expenses going from an employee payout standpoint, which technically is not a bad thing, because when I speak to you about where I think the next cycle can come from, I'll talk to you about 21 to 24 being a public capex cycle and where we think the next cycle can come from. So this naturally leads into macro, correct? In terms of what can deliver growth into the next cycle. It's because of this macro that we are in that the RBI has had to intervene in an aggressive way. What this means is both a repo rate cut as well as a CRR rate cut. And interestingly enough, because the headline inflation as reported by the government is dropping, it has given enough ammunition for the RBI to drop rates aggressively. So you have a macro which is extremely conducive in an environment where, though the capex spends may not reach from the public capex side what we expect, the liquidity in the system is fairly conducive. So you both have a push and pull in terms of where the macro is. Now, into this environment, how does one think about structuring the portfolio? Now, again, in the last two quarterly calls, I spoke to you about earnings while they are at low double digits and maybe they end up in the year at high single digits. This earnings is narrowing. What that means is that should get reflected in price action as well. If you look at the first 6 months of the year, in terms of the number of companies that are beating Nifty 500, today that number is 36.6%, and it changes depending on where the market cap is. So for example, large cap, 41% of the companies are beating the index, whereas in small cap, that number is 33%. What this effectively means is over the last two quarters, have been highlighting that earnings growth is narrowing, which is getting translated in terms of price action as well. And I expect this trend to continue into the next 2 to 3 quarters too. What this effectively means is this is an environment where when you have reasonable valuation based bottom up companies, you can concentrate. So this is an environment where you don't want to be building too much of diversification in a portfolio. And hence, if you look at our portfolio, the number of names across the portfolio would have dropped. In terms of how this is positioned from a market cap perspective, I have been speaking about the fact that liquidity in the market may fall, which means you don't want to be paying up to be owning small caps in this environment. And again, the definition of small caps keeps changing. But if you look at our weighted average market cap, today it's at 3.3 lakh crores. One other aspect that we measure is what is the active ratio of the portfolio. What that means is how much of our portfolio is different from that of the index. Today it's at 68%. Ideally, we would like this number anywhere between 60 and 75%. Just because an active ratio is high, it doesn't mean it's good. It has to be a function of where the growth is coming from and how deviant do you want this portfolio to be. Obviously, the lower the number, the more closer you are mimicking the index, which is not the aim at all. So put all of this in context, what kind of sectors do we want to be positioned in? So in the past calls as well, I've always spoken about why do cycles matter. So there are two tables here, one at the top, which explains in roughly 4-year cycles in the past, how has Nifty 500 done, which is the row at the top, alongside the sectors that have done correspondingly against Nifty 500. So, for example, if you take the four benchmark sectors in India, right, leave banking and financial services for once right now. You have auto, cap goods, healthcare, and oil and gas. You will see that each sector goes through periods of rotation. There is not one sector, irrespective of what narrative that you can make around underpenetration or valuation comfort, that has consistent outperformance across time. And hence, it's really important to basically position yourself in the right sector into this next cycle, which we think can start from early next year. Till then, like I told you, our expectation is earnings narrowing. So positioning of portfolios becomes that much more important from a bottom up as well as a top down perspective. So you can look at, for example, auto. Auto had two brief periods of outperformance between 9-12 and 13-16. And this auto includes both four-wheeler, two-wheeler, and ancillaries. However, the period in leading into COVID, the 4 years, saw a significant underperformance, and then the base effect took over, and you saw reasonable outperformance in the last 4 years. Today, where we sit on auto, we look at auto may have 1 to 2 years of consolidation and a potential underperformance into the next 2 years, which is why if you look at our auto exposure, it has been coming down into 24 and this year as well. So each sector goes through these cycles. The cycles are a function of valuations, public capex spends, private capex spends, as well as how that translates into on-the-ground execution. So understanding these cycles is extremely important to understand when you overweight a particular sector, is the risk reward reasonably high for you to position yourself there? So for example, today, one of the sectors that we have positioned ourselves reasonably high as an overweight is in healthcare, which initially I spoke to you about Jan and Feb cost the drawdown. But if you look at it, it has had a reasonable period of underperformance, which we think can mean revert into the next cycle. And there are multiple bottom-up factors that we see, right from CDMO, right from the first in-licensing deal ever that has gotten signed in India, which will result in tailwinds for this particular sector. So leading into this, how are we positioned from a sectoral perspective? Today, as we look at it, banking, which includes both banking and NBFC, healthcare, and consumer. These continue to be the three sectors where we are overweight. It is very consciously that we've split insurance and we're not putting it under banking and financial services. We do have a reasonable overweight in insurance as well. Our logistics exposure is coming from ports. We are significantly underweight IT, which we have been for a while. And we are overweight both discretionary and staples. And we also have, like I have covered in previous calls, a small overweight in the metals and mining space. So today, if you look at the March quarter numbers that have come out in two sectors that we are overweight, for example, which is healthcare and consumer, not only would you see better growth, but you would also see a stronger margin profile in terms of where we are positioned. So if you go deeper into this, if you look at in terms of our growth, there are two variables that we look at in terms of where growth comes from. We want both top line growth alongside cash flow driven growth, which means the margins that the companies generate, is it translating into cash flow based growth? And is that translating into bottom line growth? Ideally, if we have done a good job of bottom up stock picking, this is what you should get both in terms of a consolidated portfolio perspective as well as the sectoral perspective that we have. Today, if you look at the March quarter numbers, both from a top line growth perspective, there is roughly a 3.5% higher growth that we are seeing in Nifty 500 against the index, as well as from a margin perspective, you're seeing a roughly 3% higher margin in the Itus portfolio against Nifty 500. And that is what we believe should translate into this outperformance in subsequent 2 quarters as well. Quickly to very cover some of the sectors and why we are overweight and where we are overweight. Again, mining and metals has two aspects to it. End of the day, it is a commodity. So you are taking a call on two variables. One is volumes and second is price. Now, in both of these places where we are overweight, both in terms of copper and zinc and basically non-ferrous metals, capacity in terms of new mine additions, not just in India, but globally, has not happened in the last 15 years. And because of dollar actually coming down, and you now have a significant demand growth globally for precious metals, there is a potential possibility of mine expansion coming through. In some of the companies that we own, for example, there is a company called Hindustan Copper. There was a mine clearance that the company achieved in July 24. Post mine clearance, there is a forest clearance that the company goes through, which should happen in the next 2 to 3 quarters, post which there should be a capacity addition of roughly around 40% against the current capacity. So you have potential tailwinds of both price and volume coming through, and this is happening after a period of 15 years. And that's where we've gone bottom up in terms of positioning ourselves. Over and above this, from a long-term perspective, because of the fact that no capex has come in both in India and globally over the last 15 years, there is a demand supply shortfall. So the price increase that you're seeing in the global LME market looks like can continue into the next 2 to 3 years. So you have both variables of volume and price that could assist you. The last thing that you want to be doing when you look at an exposure here is you want to be focused on the balance sheet. So you don't want too much of leverage in your companies, because as they expand mines, you want to understand how they are going to be capitalizing those mines. And like I spoke to you, the metal prices should act as a tailwind. And there is a volume growth trigger that we expect in some of these companies over the next 3 to 6 quarters. The second aspect is on banking. While we increased our banking exposure significantly from November 24 to Jan 25, it's only across three companies. One is HDFC Bank, second is ICICI, and a smaller exposure in City Union Bank. So I still believe that from a sectoral perspective, we are not bullish the entire banking space, because if you look at it, even today, the credit and deposit level growth continues to be muted. While we expect this to increase because of the liquidity in the system, it might take 1 or 2 quarters, depending on which bank you're talking about, for this to actually happen. Second, like I've spoken in the past, the credit cycle has actually been extremely favorable. As a result of which, the NPA cycle today, both for private sector banks as a category and public sector banks, looks as the same. So if you take the private sector banks and do a mean normalization of your net NPA, that is equal to your public sector bank's net NPA. The last time this happened was 20 years back. As a result of which, you have both sectors having a reasonably clean balance sheet. So from here, any surprises can be on the negative side. And there are multiple sectors. For example, today, power can result in certain bad loans coming out in the next 1 to 1.5 years. So to basically say that the NPA cycle has bottomed out and will not expand, I think is risk that is getting built into the system. So to go and say blanket, I am bullish on banking, I'm not sure makes a lot of sense. Second, when you look at the slippages in the system, the chart on the left and the right basically give you a similar trend. The chart on the left gives you the total slippages in the system, how it has been actually changing. And the chart on the right gives you the write-offs around, from a risk weight perspective, how it has actually changed in the last 1.5 years. So if this continues to tick up, you would have to be a lot more careful on the quality of the underwriter, which I think is going to become extremely important over the next 3 to 4 quarters. So the framework for us in terms of where we want to be positioning ourselves is, while the environment is not lending itself into a 15% plus growth, you want to be picking those places where growth is not getting compromised. But more importantly, you don't want to be you want to be ensuring that your NPAs don't pick up and the banks have provisioned for it adequately. Third, and most importantly, you want your lower cost of funding in terms of those places where there is CASA ratio, especially in terms of the banking system. So these three will become non-negotiable as you move into the next cycle of growth. Uh, in terms of the second sector I spoke to you about, which is consumer, I'll focus on staples here. This sector has underperformed for the last 4.5 years, predominantly because you had volume degrowth. However, there are a few companies over the last 3 quarters, predominantly driven by the rural recovery growth, which have shown and continue to show double-digit volume growths. This, these are the two areas where we would want to be positioned on. You want those companies in the down cycle who have managed margins well. And if this rural recovery continues to actually show tailwinds over the next few quarters, which is what we believe you should see, you should start seeing both volume as well as price growth give you 13 to 14% top line growth, which has been lacking for the industry for the last 4 years. So broadly, for us, where we've been positioned in this space is Marico and ITC. And one of the few companies in the March quarter which showed a double-digit volume growth was Marico. So again, out here, I'm not saying consumer staples as a category is a buy. I'm saying that there are specific bottom-up companies that can tend to outperform over the next few quarters, considering that you had four years of poor volume growth. So putting it all together, what are the expectations for the year over the next 2 to 3 quarters? We continue to expect narrow earnings growth. In terms of analyst estimates, the estimates, while they have been cut by 4% so far in the last quarter, we still believe that the expectations of a 12.5% growth of earnings into FY26 is a bit aggressive. So there could be 1 to 2 more quarters of an earnings cut. Somewhere towards the early part of next year, which is Jan to March 26, we believe that the next cycle of growth should kick up. Now, this cycle should ideally come from both the supply and demand side for it to have legs. We have seen that very early signs of private capex actually picking up from the public capex side, which was the previous cycle between 21 and 24. Though today only the large companies are actually doing this capex. So, for example, when you look at the capex growth, while the numbers might look healthy, 70% of this capex is coming from 8 to 10 companies driven by mining and metals and companies like Reliance, which should flow through into the next few quarters into some of the other companies. But for that, you need the demand cycle to pick up. Currently, while there are no levers for that demand cycle to pick up, I think Jan 26, when the next pay commission comes. So the previous pay commission it's a 10-year cycle. The last pay commission was in Jan 16. The next pay commission is in Jan 26. That should result in some kind of an inflationary trend in wages, and that could cause the demand growth. So putting this together, I think the next 6 months may look like an earnings growth compression, fewer companies outperforming. So positioning in those companies and the right sectors becomes important, which should result in the next cycle coming from 8 to 9 months down the line. Broadly, leading into this, the next two slides basically talks about the portfolio level positioning broadly in terms of the single stocks that we own and the sectors that we own. Like I spoke to you about, our banking exposure is in 3 banks. Our NBFC exposure is with Bajaj Finance. This is our banking and NBFC exposure today. In healthcare, we are overweight both in terms of Indian pharma, CDMO, as well as the branded companies. So we own Reddy's, Oro, Piramal Pharma, and Eris Life Sciences. In terms of FMCG, like I spoke to you about, our larger weights are coming from Marico and ITC. I spoke to you about the minings and metals exposure, where we own and why we own it. Consumer discretionary is one space that we might look to increase our exposure if valuations come off a bit more. Our auto exposure, we have been neutral to underweight, and we might cut it even further in the two-wheeler space and continue to own only two companies, which is Eicher and TVS. In terms of financial services, we've trimmed a bit of weights into this rally in HDFC AMC, and we've not been buying the business for new clients, but this is more of an old exposure for older clients that we are carrying. Insurance, today we only own General. We have increased our weights in chemicals, and that's a sector that we would continue to increase our weights in this year. So chemicals is one sector where the last 3 years, significant capex has gone in, as a result of which ROEs have compressed. As the demand cycle comes back, the capacity utilization should increase, and you could see a new cycle in chemicals coming through. So you will see our bottom-up company exposure going up incrementally in the chemical sector this year. And in building materials, we own predominantly cement, and that's an exposure that we like as the consolidation play begins to take shape. IT, like I said, we are underweight the sector, but the only company that we own is KPIT, where we think another 2 to 3 quarters of order book normalization, and post which the company should get back into the growth cycle. This is broadly how our portfolio is positioned. I'm going to stop here and look at answering any questions from anyone. Any questions, you can put it into the chat box, and we'll take it up one at a time.
Thank you, Naveen, for the lovely presentation. Investors who have questions can type in their questions in the Q&A button. The identity of investors are protected, as the questions are only visible to the panelists. Naveen, I have a question here. How do you see money flow into the market over the next, say, till December, over the next 2 quarters?
So in the last 3 months, we've had multiple conversations with FIIs. The unanimous view around FII view on India continues to be optimistic. However, the only pushback we get is on valuations. Now, what that means is any dip should and will get bought as far as FII flow is concerned. Now, after a period of 15 years, incremental money is moving out of the US. Where is it going to? Most of the incremental flow, as we speak, is going to Europe. And as a result of which, today, if you look at it, the first 6 months of the year, the best performing market is DAX, which is a German stock market. And maybe after that, FTSE. So as we speak, EM is not getting incremental flows, but the normal index-based flows EM gets, India is a part of. So as a result of which, the FII flows for the first time this year turned positive in June, where you saw both from a primary and secondary market perspective, 20,000 crores of FII flow coming into the market for the first time. I think that can continue into the rest of the year, but I don't think it will be extremely aggressive. Somewhere along the way, any corrections, if we get it, will get bought aggressively. That's the baseline view as far as FII flows are concerned. In terms of domestics, that doesn't seem to be abating at all. I think the default view of SIP money has flatlined at 25 to 23, 26,000 crores per month. That continues. Small cap funds, despite the valuation, continue to get strong inflows. So the domestic flows doesn't look like it's going to abate. So I think market will get supported from a flows perspective. So even the base case view of earnings narrowing, there is a support on the flow side. Even the base case way of macro public capex spends coming down, there is a floor in terms of the RBI policy being easy. So both macro and micro, you have a floor today, and hence from a selection and allocation perspective becomes that much more important.
Understood, Naveen. Thank you for this. How do you see the metals playing out? Let's say gold, copper, zinc. What are your views there?
I think it can. So, unfortunately, in India, unlike the US, all your metals companies are PSUs. You don't have private sector companies who have licenses to mine, as a result of which you will have to be careful from a capital allocation perspective, because that will always come under question. While you have tailwinds, so for example, what do I mean by this? At a time where copper prices are at an all-time high, in terms of getting your clearances should be a 3-month uh, timeline at best. Today, we are dealing with 1.5 years of back and forth. So you are constrained by the government's regulatory policy, as a result of which you will have to manage your exposure appropriately. So while I am bullish, I still think you will be faced with drawdowns because of dealing with PSUs at the core, as a result of which what should take maybe 3 months can take longer, but the cycle is favorable for metals.
Understood. I mean, thank you for this. I mean, we see a lot of noise on the tariff side. Is there any tangible impact which would follow?
So I think so far, all the noise that has been generated has been from the US, right? So you haven't seen any noise in terms of counteraction from any other country. So if you look at it, does US have a choice? With the debt framework that has been passed in the recent bill, they are not cutting their debt in any significant way. There is some talk around the fact that somewhere in December, when their interim bill gets passed, there will be further cuts. Now, if there are cuts on spending, that has to get backed proportionately by increase in revenue as well. And hence tariffs will come. Now, I think the market has priced roughly a 10 to 15% broad-based tariff, which incrementally results in roughly $650 billion of revenue. So anything higher than that, if it gets finalized, may look negative, but I don't think that will be the case. So any noise, so for example, there are tweets that get published, noises that get published. I'm not very sure that will cause incremental noise anymore. Market has to a base case priced in the fact that tariffs will come, but as a result of which I still think that is going to cause more uncertainty in the US than certainty. And hence, I make the statement that incremental dollars going into the US as a default is not the base case anymore. And hence, dollars as a base currency should depreciate even further.
Understood. We had this report from Viceroy about 3-4 days back on Vedanta. How do you view this?
So I think if you look at if you look at Viceroy's background, uh, they don't have a great history of short selling either. They have targeted 2 companies in India in their entire history. One company has an operation in India, but it's not an Indian company. It's called Truecaller. And the second company that they have come out with is Vedanta. If you read the entire allegation case as well, in terms of the interest spend that they are talking about and the cost of capital, basically they're talking about the fact that the net borrowing cost of Vedanta comes out to 12.4%. But even in the recent borrowing that Vedanta did, that was at 10.8. The weighted average cost of interest for Vedanta is at 10.9. So there still are discrepancies between what the balance sheet of Vedanta shows and what Viceroy claims. Second, there are assets right now that Vedanta is looking at demerging. While the timeline for the demerger has been put aside, in terms of as the prices of the actual underlying commodities go up, it is beneficial to the company and not detrimental. Third, if you look at it, Vedanta has a delevered balance sheet today. If this report had come in 2020, it would have made a lot more, it would have given them a lot more credibility, because the debt to EBITDA was roughly 3 times where it is today. So the company has already delevered and they have plans of delevering even further. So today, I don't think if you analyze their report, while in this closed forum, we have set up a meeting with the company to ask a few clarifications based on the work that we have done, which we should get a meeting in the next quarter post the company's earnings. I don't think the thought or the piece is well researched. So I don't look at this to say that there is a big concern as we speak on the company. Where can the concern come? Three areas. If the debt increases from here, if metal prices go down significantly from here, and the demerger is not a negative event. Sorry, if the demerger doesn't go through, it's not a negative event, but the demerger goes through, it's a positive event. So these are the three risks for the company over the next 3 quarters.
Understood, ma'am. Thank you. I mean, how do you see the portfolio performing against the benchmarks over the next year?
So I think if I break it down into the next 2 quarters, I look at a steady outperformance over the benchmark to start off. This outperformance that we have seen from March to June, I expect that to continue into the next 2 quarters. I don't see a cycle change in the next 2 quarters. So our positioning should result in that outperformance. It's not a single company that will drive our returns, but the fact of not owning underperforming sectors versus owning those sectors that continue to show growth at a portfolio level, risk adjusted should drive this outperformance. I think once I see tangible evidence of the next cycle coming through, you will see us increase weights into that next cycle. Right now, we're not doing it because it's still early signs to do it. So if I just give a guidance for the next 2 quarters, what you saw in the last quarter in terms of outperformance, I expect that repeatability into the next 2 quarters.
Understood, Naveen. Thank you. Naveen, one last question. Now, how are you deploying? How do you view to deploy capital in this market?
So, as I communicated today, I don't see the need or the hurry to be deploying 100 rupees on day one. So, in terms of the clients, for example, that came in last month, you would see only 68 to 70 rupees deployed as we speak. For example, I'll take two examples. One of our larger exposures is in, let's say, HDFC Bank. Today, with gains that has gone to around 10.8% in some of the older clients' portfolio. In a new client portfolio, we would not be buying more than 6 to 6.5% exposure. So, end of the day, each stock's weight will reflect today's valuation and where we think the incremental IRR can come from. So, many of the stocks that we are buying, we are upsizing it over time as earnings come through, or if we get any volatility. Like I said, I am looking for opportunities to increase our chemicals exposure. I am looking for opportunities to increase our insurance exposure. We will do it if incremental earnings come through higher than surprises, or if valuations come down from here. So the capital that is given should take around 3 to 4 months to get deployed as we speak.
Thank you, Naveen, for this. Over to Maggie.
Thanks, Naveen and Ajit, for the Q&A session. The recording of this webinar will be sent out over the next week. Thank you all once again for the patience on the call. Have a wonderful weekend.
Thank you to everyone for this. Appreciate this and have a lovely day.